September 1998, Greenwich, Connecticut. A hedge fund managing $126 billion is hemorrhaging money so fast that its collapse could trigger a global financial meltdown. The Federal Reserve calls an emergency meeting. 16 bank CEOs gather in a Manhattan conference room, forced to orchestrate a $3.6 billion bailout to prevent economic catastrophe. The fund losing this money, long-term capital management, run by Nobel Prize-winning economists using sophisticated mathematical models. But here's the twist. While LTCM is watching their empire burn, another mathematician's fund, Renaissance Technologies, is quietly generating 98.5% returns that same year. His name is Jim Simons, and over the next 3 decades, his algorithms will average 66% annual returns, making him the most successful investor in history. Not Buffett, not Soros, a mathematician who saw what the entire financial establishment missed. How did he do it? And what did he understand about markets that still terrifies traditional traders today? Long Island, 1952. A 10-year-old kid lies awake calculating prime numbers in his head. Jim Simons isn't like other kids. While his classmates struggle with basic algebra, he's teaching himself calculus from library books. At 14, he takes a summer job stocking shelves at a garden supply store. His boss keeps finding him in the back room, scribbling equations on cardboard boxes. He gets fired after 3 weeks. Years later, Simons will joke that getting fired for doing math was the first sign he was on the right path. MIT accepts him at 16. He completes his undergraduate degree in 3 years. Berkeley awards him a PhD at 23. His dissertation on multidimensional space is so advanced that only a handful of people on Earth can understand it. But instead of pursuing pure academia, he joins the Institute for Defense Analyses, doing cryptography work for the NSA. For 7 years, he cracks Soviet codes by day and pursues theoretical mathematics by night. Then in 1968, everything derails. Jim gives an interview to Newsweek criticizing the Vietnam War. His security clearance gets revoked. He's fired at 30, with a family to support and controversial views that make him toxic to government research. Stony Brook University takes a chance on him. He becomes chairman of the mathematics department, rebuilding a struggling program into one of the nation's best. He should be content, but Jim is restless. Pure mathematics feels disconnected from the real world. It begins with currency trading in the late 1970s. Jim notices patterns in how exchange rates move, correlations that seem predictable over short time frames. He's not reading financial news or studying economics. He's treating price data like any other mathematical sequence, looking for statistical regularities. Other traders rely on gut feeling and insider information. Jim sees only numbers and patterns. In 1978, he launches his first fund, Monometrics. It's a disaster. The models work in backtesting but fail spectacularly in live markets. After 2 brutal years, he shuts it down, having lost millions. Most people would quit. Jim doubles down. He spends the early 1980s refining his approach and recruiting the right people. Not traders, not MBAs, not anyone from Wall Street. He recruits cryptographers, physicists, astronomers, computer scientists, anyone with deep quantitative skills and zero attachment to how trading has traditionally been done. In 1982, he launches Renaissance Technologies. The early fund, Limroy, focuses on currencies and commodities, trading purely on mathematical signals. It works this time, generating steady 30% annual returns through the mid-1980s. Jim realizes the real edge isn't in finding big, obvious mispricings. It's in tiny, fleeting inefficiencies that exist for microseconds or minutes. Patterns so subtle that only statistical analysis across massive data sets can detect them. In 1988, he launches the fund that will become legendary, Medallion. The first year is rough. Medallion loses money. Jim fires his initial managers and brings in 2 former colleagues from his NSA days, mathematicians who'd pioneered speech recognition at IBM. They redesigned everything from scratch. The transformation is immediate. Starting in 1990, Medallion generates returns that seem impossible. 55% in 1990, 39% in 1991, 34% in 1992. And these are after Renaissance takes its unprecedented fees of 5% management and 44% performance. Before fees, the fund sometimes generates over 100% annually. What's happening inside Renaissance is algorithmic trading before the term exists. The models analyze thousands of securities simultaneously, identifying correlations that persist for brief periods. That small edge, multiplied across thousands of daily trades, compounds into extraordinary profits. Jim builds one of the world's most advanced computing systems, storing decades of price data at tick-by-tick granularity. Every model must prove itself statistically before deployment. Traders can't override the algorithms based on intuition. The machine decides. This is heretical on Wall Street, where star traders build reputations on market instincts. At Renaissance, instinct is irrelevant, only data matters. By 1998, Medallion is the most successful hedge fund in the world, managing traffic from 25 million users globally. The firm guards its methods obsessively. Employees sign ironclad non-disclosure agreements. Renaissance publishes no research and reveals nothing about its strategies. The secrecy isn't paranoia, it's survival. If competitors understood their edge, they'd replicate it, and the inefficiencies would disappear. Then comes the crisis that validates everything. In August 1998, long-term capital management implodes spectacularly. LTCM had used mathematical models to place massive leveraged bets on bond spreads. When Russia defaulted and markets panicked, those bets went catastrophically wrong. Within weeks, LTCM is insolvent, threatening to take down major banks if it fails. The Fed orchestrates an emergency bailout. The financial press declares quantitative finance a dangerous experiment gone wrong. Wall Street watches to see if Renaissance will suffer the same fate. After all, they use similar approaches. The results shock everyone. While LTCM is losing billions, Medallion generates 98.5% returns in 1998. How? The market chaos that devastated LTCM created exactly the volatility that Renaissance's models thrive on. Panic selling creates predictable patterns. The difference is fundamental. LTCM made massive directional bets on specific outcomes. Renaissance makes thousands of tiny, uncorrelated bets, diversified so completely that no single event can destroy the fund. Jim later explains it simply. We don't predict where markets are going. We identify patterns that have a slight statistical edge, and we trade them systematically. After LTCM, capital floods into quantitative strategies. But here's where Jim makes an unprecedented decision. Starting in 1993, Renaissance begins returning outside investor money from Medallion. By 2005, the fund is completely closed to external investors, managing only money from Renaissance employees and their families. The reason? Capacity constraints. The inefficiencies Medallion exploits exist in finite size. Jim would rather manage less money at higher returns than become another giant fund-generating average performance. This decision is unheard of in finance. Every other successful fund maximizes assets to collect larger fees. Jim walks away from billions in potential income to protect performance. The returns continue defying belief. From 1988 to 2018, Medallion averages 66.1% annually after fees. To put this in perspective, $100 invested in 1988 grows to over $42,000 by 2018. The same amount in the S&P 500 grows to around $2,000. No other investment vehicle in recorded history matches this performance. What exactly are Renaissance's models doing? This remains one of finance's deepest mysteries. The algorithms incorporate machine learning, identifying patterns humans can't perceive. They model market microstructure at millisecond timescales. They use natural language processing to extract signals from news. They predict how other traders will behave. But the specifics remain locked inside Renaissance. The firm has never been hacked, never had significant leaks, never had a departing employee successfully replicate their approach. Jim steps back in 2009, handing control to protégés who prove the system transcends its founder. He spends his final years focused on philanthropy, donating billions to autism research, mathematics education, and fundamental physics. When he dies in May 2024 at 86, he leaves behind a legacy extending far beyond finance. Renaissance Technologies continues operating today, managing over $100 billion. Medallion remains close to outsiders, still generating spectacular returns for its exclusive group of employee investors. The firm spawned an entire industry. DOE Shaw, Two Sigma, Citadel, all follow the Renaissance playbook. Hire PhDs, build models, trade systematically. But none match Medallion's performance. Whatever edge Renaissance discovered remains proprietary. Jim Simons proved that markets, despite seeming chaotic, contain hidden order detectable through rigorous analysis. He showed that removing human emotion produces superior results. He demonstrated that scientific methodology generates returns where traditional approaches fail. Today, algorithmic trading accounts for over 70% of equity market volume. The revolution Jim started has consumed the industry. Yet Renaissance stands apart. Even among quantitative firms, its performance remains unmatched and unexplained. Critics argue this proves markets are broken, that sophisticated algorithms exploit structural flaws rather than provide legitimate value. Renaissance counters that they provide liquidity and make markets more efficient. The debate continues. What's certain is this: Jim Simons built something that outlasted him. Somewhere in Renaissance's Long Island offices, algorithms he designed decades ago still operate profitably, still exploiting patterns invisible to human perception. The firm stands as proof that sometimes the greatest fortunes don't go to those who understand markets best, but to those who understand mathematics best and apply it where others never thought to look. The mathematician who broke Wall Street didn't just make money. He fundamentally changed how markets operate and proved that mathematical truth works, regardless of whether you believe in it. His algorithms keep running, profitable as ever, still finding the patterns he discovered 40 years ago. And those patterns persist, waiting for the next mathematician brilliant enough to discover them independently. Because that's the thing about mathematical truth. It doesn't care whether you believe in it, it just keeps working.